Many traders mistakenly emphasize high win rates, operating under the assumption that these rates are paramount for achieving profitability. However, it is imperative to recognize that risk-to-reward ratios also play a critical role in determining long-term success in trading. In fact, higher risk-to-reward ratios can significantly enhance profitability by empowering traders to allow their gains to run. This stands in stark contrast to lower ratios, which may appeal to novice traders primarily for their psychological comfort. Moreover, the implementation of effective profit-taking strategies is essential in order to prevent winning trades from devolving into losses. Techniques such as establishing multiple profit targets and maintaining diligent tracking can greatly assist in securing profits. Setting an initial target at a 1-to-1 risk-to-reward ratio equips traders with the ability to secure a winning trade while simultaneously mitigating losses. This strategy ensures that profits are locked in early in the trading process. Additionally, the practice of opening two separate positions with adjusted risk parameters can facilitate more effective trade management. This approach provides traders with the flexibility needed to target varying profit levels. Furthermore, identifying pivotal levels on higher time frames can guide traders in selecting appropriate second targets. This strategic method leverages historical price action to forecast potential future market reactions. Repositioning stop losses to break-even points allows traders to protect their profits from winning trades while concurrently reducing risk on forthcoming trades. This tactic is vital for effective risk management within trading operations. Moreover, employing the latest market structure for stop-loss placement enables traders to secure profits while still benefiting from prospective price escalations. This methodology fosters a more composed trading approach. In addition, tracking strategies empower traders to capitalize on substantial profit potential without succumbing to the fear of losses, as these strategies adapt dynamically to evolving market movements. Consequently, traders can reap the rewards of gains while minimizing emotional stress. A robust risk-to-reward ratio can markedly enhance a trader's capacity to manage their accounts effectively while alleviating stress during trading activities. This capability is pivotal for achieving consistent profitability. Traders are encouraged to backtest their strategies against real market charts to ascertain their efficacy prior to implementation in live trading scenarios. Such practice fosters heightened confidence in decision-making processes. Additionally, comprehending candlestick patterns, including the advanced bearish engulfing pattern, is fundamental for making informed trading decisions. These patterns can serve as indicators of potential market reversals. Engulfing candlestick patterns provide critical entry signals for traders, effectively guiding decisions regarding when to initiate short or long positions. A thorough understanding of these patterns substantially enhances trading accuracy. The concept of risk-to-reward ratio remains integral to successful trading practices. By managing risk through strategic position sizing, traders can better safeguard their capital against market fluctuations. Finally, tracking profits necessitates the adjustment of stop losses in alignment with price movements to secure gains effectively. This technique underscores the importance of backtesting to confirm its reliability across diverse market conditions.